The duration on that is about 18 years. So a 1% move, upward move in 30 years yields results in about $18 billion worth of or 18% losses. Let's see the movement of 30-year yields since the end of the year. It's 365 now, but beginning of the year it was about 397, but it went down as low as 366 before the collapse of SVB. It was at 402. Let's look at 1 year because we don't know. We don't know when exactly they bought these bonds. As late as 1 year ago, 30-year yields were around 2.5. So depending upon when they bought, but either way, there was a lot of unrealized losses already accumulating. Okay. And if you take that kind of risk, basically they chose not to hedge that risk. We know we have instruments like Eurodollar futures, swaps, there are even swap futures and options. You have no excuse, if you choose to do so, not to be able to manage interest rate risk. Okay, you just chose not to. And why? You know, if you take that much risk and you make money, remember, these guys, banks, are essentially leveraged instruments, right? You got $16 billion in capital. You have $120 billion worth of just T-bonds. Just those are about leveraged 8 times. So you buy a bond, 30-year bond, interest rates go up by 10 basis points, you're going to earn 1.8% roughly. But if you're leveraged 5 times, you're earning 9% on your capital. If interest rates go down by 50 basis points, multiply that by 5, 45%. A large bank earning 45% on its assets, on its equity, is very high, okay? What happens when a bank like that has a very high return on equity? The stock price goes up. Who benefits from that? In addition to the stockholders, top executives, because they have stock options. I'll show you the filings of SVB. Ownership disclosures just on February 28th. No, I'm sorry, that's just on March 1. The actual transactions happened on February 27th, but they announced it, they filed it on March 1st. The CEO exercised options with a strike price of 108 for about 12,000 shares, and more than likely those options were going to expire at the end of this year. So they have kind of a defense against insider trading accusation. But week one, that guy made over $2 million on those trades. Because on the same day, he sold them at 287 or so. There's also another trade on that day by the CFO. He basically sold $400,000 worth of stock. Do you really think that that was an accident? More than likely not. I mean, let's look at the price of SVB. Over the last month or so, or 1 year. About a year ago, that stock was trading at 576. There were already signs that they were in weak position. I mean, by that time, they were down about 60% compared to beginning of last year. These guys haven't exercised those options here. When the stock was 600, suddenly they exercised it when the stock was at 287. So they knew it was coming. Of course, proving that in a court of law beyond a reasonable doubt is a different hurdle. But as you know, when it walks like a duck, it probably is a duck. And 5, it's kind of like these firms had cash because they were being financed by SVB, and those cash were deposits at SVB, and they withdrew the money that they borrowed from SVB to kill SVB. Do you think anybody's going to lend them that much money anymore? I'm talking about a single bank. SVB was famous for being the bank for the Silicon Valley. I mean, as the name suggests, Silicon Valley Bank. They pretty much finance all the venture capital stuff. So these were pretty much the culprits. But none of this, if you had information about SVB, none of this was a surprise. Especially if you were a regulator in residence, you were going to mark to market their assets every single day. So the danger signs would have been coming. I mean, let's look at year to date, 30 years. Right around here, it was 353. It went as high as 402. That meant a 30-year bond would have lost about 10% of its value during that period. And these guys have $120 billion in assets in probably T-bonds. Not all of them are 30 years, but they would have lost a lot of money. A regulator that was in place would have seen that. They would have actually done something about it, probably around here. A 25 basis points move would have required a capital infusion of maybe 1 billion, and that would have been relatively easy to raise. Now they can't, or they couldn't, because most banks knew that these guys had concentration of lending. And who's going to say why Fed actually decided to backstop all the deposits at SVB? Hence, then at not First Republic, Signature Bank. Now, First Republic is kind of in trouble as well. Why do you think they did it? Is it to rescue the big money people who contribute a lot to political campaigns of either party? Was it a political move or was there something behind that? Something else behind it? What do you think would have happened if Fed decided that uninsured deposits would have been essentially wiped out? What would be the first move of firms that have uninsured deposits? They were going to go after to withdraw the uninsured deposits. But the banking system as a whole has a lot more deposits than they have liquid assets for. JP Morgan alone could not probably meet a bank run. So if you let SVB uninsured deposits die, that would have been a bank run even on the healthiest of the banks. You can't handle a simultaneous bank run on large banks, period. That's the way the banking system is. We can handle a big earthquake here and there, but you cannot, you can basically handle a very big earthquake, but not a meteor shower of big size. Okay? You just can't handle it. That's the way the system is. We should have made 2008 a joke in terms of the depth of the recession. Because this would have been a credit crunch recession. Banks would not have created new loans, period. And they would not have renewed the maturing existing loans, which would have meant a lot of small and mid-sized firms would have gone bankrupt. They're the biggest engine of employment. It's not just the tech industry that's going to be in trouble. It's the entire economy. Even now, market is pricing a mild recession. Which even caused markets' view of Fed actions change.